Welcome to vTalkInsight, Risk Sentiment Daily for January 8, 2026. Global markets are leaning into AI and cyclical growth stories, even as valuations stretch and geopolitical risks flare. Let's unpack what that balance means for risk appetite across assets today. Risk sentiment today is best described as cautiously risk-on. Equities are coming off a broad-based rally, with gains not only in large-cap tech, but also in small caps, cyclicals, credit, and even base metals and crypto-related exposures, all pointing to strong appetite for growth and risk. At the same time, cross-asset signals show investors are not complacent. Government bond yields in the US and Europe are edging lower, suggesting a cautious bid for duration, while gold continues to attract central bank and investor demand as a hedge against macro and geopolitical uncertainty. Equity volatility remains relatively contained, and the S&P 500 has only slipped modestly, consistent with a market that is still leaning into upside but recognizes that shocks are possible. In practice, many portfolios appear to be staying invested in growth themes like AI and cyclicals, while adding diversifiers in real assets and duration, keeping the overall tone constructive but clearly two-way. A key bullish driver is the AI-driven productivity and earnings boom. Corporate margin forecasts are being pushed higher, with projections for S&P 500 margins approaching the high teens, underpinned by expectations that AI can deliver efficiency gains of 20 to 40% in some sectors. Company commentary reinforces this backdrop. NVIDIA signals that revenue in 2026 could exceed prior expectations, helped by large custom deals, rising cloud pricing for AI chips, and diversification into areas like automotive, robotics, and industrial automation, while its new Vera Rubin GPU platform promises order-of-magnitude improvements in energy and cost efficiency. Beyond one name, strong demand for high-bandwidth memory and storage is driving outsized gains in memory producers, and investors are broadening AI exposure into Asian chip manufacturing, data center infrastructure, and industrial automation partnerships. This supports forecasts for double-digit S&P 500 earnings growth over the next 2 years and underpins targets implying further upside, making AI not just a tech story, but a central foundation for the current risk-on regime. The second bullish driver is a broadening equity rally and sector rotation. Recent performance shows gains spreading from a narrow group of mega-cap tech leaders to small caps, equal weight indices, and sectors like financials, industrials, banks, and materials, helped in part by surging memory chip names and improving earnings expectations in cyclicals. Flows and narratives point to investors adding exposure across regions and sectors. There is growing interest in software, pharmaceuticals, and energy infrastructure alongside AI, while international markets such as Japan, India, and select European bourses are highlighted for relatively higher growth and lower valuations, and European defense stocks are outperforming as budgets rise and spending tilts toward electronic warfare and air defense. This broadening leadership matters because it reduces reliance on a handful of megacaps and supports the idea of a more durable cycle in risk assets. That said, parts of industrials and cyclicals now trade on rich valuations relative to still muted purchasing manager indices, so the sustainability of this rotation will increasingly depend on whether the hoped-for global growth reacceleration actually materializes. The third supportive force is disinflation and future rate cut hopes. Eurozone inflation remains subdued, recent German data point to downside risks, and central banks there are seen keeping policy on hold rather than tightening, while in the US, falling market yields reflect expectations that inflation has peaked and will continue trending lower. In this environment, markets are leaning toward a Federal Reserve rate cut around mid-year, helped by forecasts of further disinflation and the prospect that future leadership at the Fed could tilt more dovish. The outlook for the dollar hinges on how many cuts ultimately materialize and how sharply U.S. growth slows, with sustained weakness likely only if the central bank eases more than currently priced. Lower rate expectations are also feeding into real assets. Base metals, including copper and nickel, are rallying on a mix of rate cut hopes, tight supply, and structural demand from electrification and AI infrastructure, while expectations of higher Venezuelan oil exports and broader supply relief are pressuring crude prices lower, reinforcing the idea that inflation pressures could stay contained even as growth assets perform. On the bearish side, rich valuations, concentration, and AI froth are an increasingly important constraint. Equity indices are trading on elevated multiples that implicitly assume a large and rapid productivity boost, particularly from AI, and any disappointment on earnings or productivity could translate quickly into higher volatility and derating. Concentration adds to this vulnerability. The top 10 U.S. equities now account for a very large share of the main index, while U.S. investors are heavily tilted toward domestic stocks, especially semiconductors, and retail investors are both overweight equities and running margin balances and AI exposures reminiscent of previous peaks, even as institutional positioning remains more neutral. Within the AI complex itself, late-stage valuations and supply bottlenecks are potential pressure points. Memory and storage costs are rising sharply, with reports of sizable price hikes this quarter and the prospect that memory soon exceeds compute in total system cost, and any disappointment in AI-related capital spending or end demand could trigger a sharper correction across this crowded theme and contribute to the kind of 5 to 7% pullback some see as increasingly plausible. Geopolitical and policy shock risk is the second major headwind for sentiment. Tensions around U.S. interest in acquiring Greenland, including public references to not ruling out military options, are raising serious questions about NATO cohesion, European security, and the stability of long-standing alliance norms. Energy geopolitics add another layer. U.S. negotiations and sanctions enforcement around Venezuelan and Russian-linked oil tankers are altering trade flows and revenues, while uncertainty over U.S. tariff policy and a pending Supreme Court ruling could reshape Treasury issuance needs and fiscal deficit concerns, all against the backdrop of an election cycle that is already producing proposals such as a retroactive California wealth tax and restrictions on institutional single-family home ownership. Markets are responding unevenly. European defense stocks benefit from expectations of structurally higher budgets, yet face regulatory threats to dividends and buybacks, while gold and silver draw support from reserve accumulation and persistent deficits, even as volatility in metals like platinum and silver is described as unhealthy for industrial demand. With the dollar still retaining safe haven appeal during geopolitical stress, this mosaic points to a higher probability that a policy misstep or geopolitical surprise could spark an abrupt volatility spike across assets. The third bearish driver is credit and liquidity vulnerabilities emerging beneath the surface. In private credit, rising redemption requests have prompted managers such as Blue Owl to raise withdrawal limits sharply in an effort to reassure investors, but these moves also highlight how illiquidity can become a structural risk if managers are forced to sell assets at discounts during periods of stress. Corporate leverage is another area to watch. A proposed merger involving Warner Bros. Discovery and Paramount would entail one of the largest leveraged buyouts on record, with around $50 billion of debt and sizable break fees, raising genuine concerns about execution, financing resilience if market conditions deteriorate, and the broader signal it sends about risk tolerance in credit markets. Housing and policy uncertainty intersect with credit risk as well. Home prices have risen nearly half since 2020, while tight supply and regulatory barriers keep new construction constrained, and political scrutiny of institutional landlords has already triggered sharp equity moves. Taken together with a surge in corporate issuance as firms lock in funding, these dynamics suggest parts of the credit and property complex could amplify, rather than cushion, any future macro or policy shock. To sum up, markets remain in a cautiously risk-on phase, powered by an AI-driven productivity and earnings boom, broader equity participation, and a disinflation backdrop that keeps future rate cuts in play. Offsetting that, stretched valuations, concentration in U.S. and AI leaders, rising geopolitical and policy tensions, and emerging credit and liquidity strains all argue for greater respect for tail risks and volatility spikes. Watching how labor data shapes central bank expectations, whether AI demand continues to meet lofty hopes, and how geopolitical flashpoints from energy to Greenland evolve will be critical for understanding the next leg in risk sentiment. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.